Okay, so I had this question, right? How does someone rent out a condo for, say, $1,600, $1,800 a month? Like, wouldn't it take like 10 years or so to make back the money on your investment?
Oh, I don't really know when that would be. It's just, I think it's just in terms of paying off that mortgage, right? You're just covering those costs. I think.
Give me a minute, I'll explain to you guys. All right, that's actually a great question. I'm gonna go through the basics of what a mortgage is and how it works, because many of you know that you should be buying real estate, but you don't know why and you don't know the math behind it. So I'm gonna go show you. This really makes sense when you have a mortgage, when a lot of people don't have the $1 million to put down in a property right away. So you're gonna have to put down 20% and then you let the tenants pay off the mortgage, right? Makes sense. Now, if you do a straight line division, it doesn't really make sense. You have to look at the basics of principal plus interest. Essentially, what a mortgage is principal plus interest, and then you add your maintenance and taxes. And if that number works out, then pretty straightforward, right? Okay, so let's go to the App Store, open up the Canadian Mortgage app. It's a great app written by some Canadian guy. I don't know who it is, but it's a really awesome app and I love using it. I'm gonna use one of our examples. Instead of $1 million property, we're gonna use 55 East Liberty Street, unit 1006, because that's what we do. We sell our properties and you gotta buy this property. Makes sense. Okay, down payment, the purchase price is $669,900. The down payment, let's assume you put down 20%, so that's $133,000. Now you can get into a property with as little as 5% down on the first $500,000, and after that 10%. So I don't know, call that 60,000 you can get in for, plus your land transfer taxes, so maybe 70 grand all in to get started. You need a bit of money. You can't just go in there with zero down. It doesn't work that way. Those days are gone. Okay, so a mortgage rate would be 2.04%. Let's say it's gonna be 30 years, and I'll explain that in a second. So 669,000 minus your down payment of 133,000, your remaining balance is 535,000, which you're gonna finance at a rate of 2.04% over the next 30 years. Your monthly mortgage payments will be $1,900.89, $1,990 basically per month, and that's made up of the principal plus interest. So $1,082 principal and $907 interest. Let's go back and finish some more. So you also have your property taxes, like I was saying, PITM, and this one is $21.81 per month, per year, which works out to $181 per month. Condo fees are $475 a month, and no heat because the tenant pays the utilities. That's how it is in Toronto. That's how we do things. Other expenses, I'm gonna say $20 because you should have a landlord insurance policy. I think it's probably the smart thing to do. And you can see here the total carrying cost is in the top right corner, $2,666 per month. Okay, so now I know you're gonna say that, hey Ken, we're only gonna get $2,200 a month in rent. This is during the pandemic or just after it. Rents haven't shot up to back where they were before it. This unit probably can get $2,500 a month pre-pandemic. So you're still cash flow negative by, in this situation, $466 a month, but it still does make sense. Just hear me out. You have the payments here of close to $2,000 a month. I'll show you a little graph of what happens. So you can see in year zero, you have a $535,000 loan balance remaining, right? Remember the original purchase price minus your down payment, and you get your remaining balance when you get through a mortgage. So as you go along, year one, you're paying that down by $13,000 a year. Year two, you're paying by 26 cumulative, right? And you keep going along the line until you hit, year 30, when it hits $0 remaining in your loan. You can see here in the red line, this is where your interest costs are, and you can see over time it'll flatline, and it'll be finished at year zero, and that's what you're gonna be paying at throughout the life of the loan, $180,000 for interest. And then, of course, it's just your principal that that's growing minus the interest that you paid gives you the balance, like the equity in the place, the green line, principal, and just grows up to $535,000 when the mortgage is done. Let's show you this in a table format. So year one, $10,000 per year for interest, and the $13,000 per year, right? In year 5, you add that all up together, it works out to $68,000 principal paid and $51,000 for interest. Now, if you're coughing up $466 a month to cover this, what's that going to cost you? $5,000 at the end of the year, maybe? So 5 times 5 is 25,000, but you're still up $68,000 in equity, right? So you minus the 2, you're going to have $43,000 in your pocket back to you, and the whole time during the 5 years, the property will go up in value. So whatever goes up in value after capital gains, after paying taxes on that, on the earnings, and any kind of maintenance costs you have to pay for over and above the maintenance fees, like fixing toilets and things like that, and any kind of fees, real estate agent fees, for example, and land transfer taxes. Minus all that stuff, that's what you end up with. Your principal plus any gain that you've had, and I'm telling you, those numbers will be really awesome. It'll be double digits per year for sure, if not more, cash on cash. Okay, so I hope that makes sense for you. I tend to ramble on a lot, so hopefully that was clear enough. But if you have any questions, you can always reach out and we can walk you through a one-on-one example of how real estate investing works. Until then, I'll talk to you next week.